Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one passively managed member of our list of 72 favourite funds, namely iShares UK Gilts 0 to 5 years ETF. Now this fund is an exchange traded fund, or ETF. And ETFs are designed to track or mirror the performance of the underlying assets and then deliver that performance minus its running costs. And, unlike most active funds, ETFs can be bought and sold in real time via a recognised stock exchange, hence the name Exchange Traded Fund. Now in this case, iShares UK Gilts 0 to 5 years uses physical or direct replication to provide the performance. So that means it tracks a FTSE bond benchmark, the FTSE UK Conventional Gilts up to 5 years index, and that contains sterling denominated UK government bonds traded on the London Stock Exchange, and none of them have got more than 5 years to maturity. Only conventional gilts are involved, so that rules out index links, as for example. Now, the portfolio consists of 13 UK government bonds and they make up just over 92% of the assets. The other 7% sits in cash. The average credit quality of the bonds in the portfolio is AA, which is very high, and the effective maturity of the traded loans is around 2.5 years. This graphic shows how the bond portion of the portfolio is split by maturity. Remember, the other 7% is in cash. Now the ETF comes with a total expense ratio of 0.2% and a 12-month yield of 0.37%, and that will come in the form of 2 dividends a year. The tracker, or ETF, has got £1.4 billion of assets under management, and for those who put faith in such things, it comes with a 1-star Morningstar ranking. As a final note, please note that the ETF trades at around £131 a piece at the moment. So, those are the mechanics. The next question to address is why could investors consider this passive fund for portfolio inclusion today? And I think there are 3 possible reasons. The first is that this tracker is in some ways as close as you can get to being in cash without actually being in cash. As such, it's a relatively convenient place to park money, eke out a little bit of yield even after expenses, and plan what you want to do next. Second, February's just seen the US stock market suffer its worst single-day loss for about 6 years, and the FTSE 100's initial surge in 2018's come to a halt as well. The UK's leading index is now down for the year. Investors are starting to worry that inflation is picking up and that central banks may raise interest rates more quickly than thought. The ETF could therefore be a bolt hole if stock markets do become more volatile. Thirdly, the current inflation worries actually could be misplaced. They have been before, and there are still some very strong deflationary forces at work, such as record levels of government debt, terrible demographics in the West, as low birth rates mean the number of new workers and taxpayers looks set to slowly fall, making it harder to fund the welfare system as we know it. There's also automation to think about and the price-crushing powers of the internet. If they exert a firm grip, inflation may not be the problem, deflation still could be. And in that case, bonds, traded government loans could still be a good place to be. However, this is not to say that the iShares UK Gilts 0 to 5 year ETF will suit every investor for 2 main reasons. First, as we will discuss, higher interest rates are the enemy of bonds because of duration. Bond yields usually rise as interest rates rise so they can compete and keep attracting investors' cash. And as bond yields rise, bond prices fall, just the same as shares. And in bonds this is known as duration, which works out how much a bond's price changes relative to a 1% move in interest rates. This is a big deal now. It won't take much of a price fall in a bond or bond fund to wipe out the benefits of the coupon on a bond or yield on a bond fund and more. At least with this ETF, its holdings have a short duration, so they're less sensitive to interest rate moves. Longer duration bonds are riskier, as more bad things can happen before they mature, and the shorter the maturity or the shorter duration, the better. It's less risky because there's less time for something to go wrong. Look here at how UK 2, 5 and 10-year gilt government bond yields have started to rise. The good news is that iShares UK 0 to 5 year gilt ETF hasn't lost much ground, but it has still lost a little bit since bond yields bottomed in mid-2016, so it's not totally immune to any wider bond market shakedown either. The second question mark is inflation, because that's the other enemy of bonds alongside interest rates. At the moment, the inflation rate in the UK, as measured by the Consumer Price Index, is 3%, as we can see here. That's way above the 0.37% yield available on this ETF. So in real inflation-adjusted terms, you're losing money on that coupon, that yield. So there is a cost here, even for the relative capital safety on offer. What this does go to show, therefore, is that investors must do their research on iShares UK Gilts 0 to 5 years ETF to make sure it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital at work. Thank you for watching, and I look forward to seeing you next time.